Welcome to the deep dive. I am incredibly glad you're here with us today.
Yeah, it's really great to be here. We've got a lot to get through.
We really do. And look, if you're listening to this, I already know a little bit about you.
Oh yeah, you're what we call the learner.
Exactly. You are the kind of person who is just insanely curious about how the world works. You want a clear, engaging breakdown of complex ideas.
Without the headache.
Right, without that overwhelming feeling of information overload.
Yeah.
You want those aha moments, the kind that fundamentally shift how you view the structures around you.
And I promise you the stack of source material we are looking at today,
Oh.
it is practically overflowing with them.
It really is. But before we jump into all of that, a quick heads up.
Yeah, we need to put a pin in this right away.
The material we're unpacking today pulls absolutely no punches.
None.
It takes some massive swings at concepts like socialism, at government bureaucracy, and it champions a very specific, very aggressive brand of capitalism.
And corporate tax strategy.
Yeah. Right. It actually frames the traditional Robin Hood philosophy as a negative rather than a positive, which is wild.
It is. So just to be completely clear.
We are not here to take a political side.
Exactly. We aren't defending one worldview over another here.
We aren't endorsing the left-wing viewpoints presented, and we are not championing the right-wing viewpoints either.
Our job today is strictly to map out these arguments, to impartially report the findings of the material.
Just laying the blueprints out on the table so you can weigh them for yourself.
We are acting purely as your guides through this specific landscape of ideas.
So, what is our mission today? We want to understand how the wealthy historically outsmarted the tax system. We want to redefine what a corporation actually is.
And spoiler alert, it is definitely not a glass skyscraper.
Definitely not. And finally, we want to look at the four pillars of what the source defines as financial IQ.
It's a lot of ground to cover.
It is. Okay, let's unpack this. And we're starting with a character we all grew up with, Robin Hood.
Yes. The material starts with a highly provocative stance on the legend of Robin Hood.
Because we're all taught in school that Robin Hood and his merry men are romantic heroes, right?
Right. The classic narrative. He stole from the rich to give to the poor.
Acting as a champion of the downtrodden against a tyrannical system.
But the rich dad mentor in our source material completely rejects this framing.
He doesn't see Robin Hood as a hero at all.
He explicitly calls Robin Hood a crook.
A crook. I mean, that is incredibly harsh. The whole point of the story is that he's saving starving people from a greedy king.
Yeah.
How does the argument justify completely flipping that narrative?
It's a jarring perspective, but it's entirely based on the psychology of society. Okay. The argument is that this Robin Hood fantasy, this deeply ingrained societal belief that it's noble and morally right to take from the rich and give to the poor.
Right.
That belief has actually caused the most severe financial pain for the poor and the middle class throughout history.
Wait, how does taking from the rich hurt the middle class? That seems completely counterintuitive.
Well, the underlying premise is that the Robin Hood ideal became the moral justification for the heavy taxation placed on the middle class today.
Ah.
Because the wealthy are not the ones who ultimately end up paying the lion's share of the burden.
It's the middle class.
Specifically, the educated upper-income middle class. That's the group that ultimately pays for the social safety nets.
And the argument is that it all traces back to society eagerly adopting this Robin Hood philosophy at the ballot box.
Exactly. And to really understand the mechanics of this, we have to look at the historical timeline of taxation.
Which is wild because when you look at the historical facts presented here, they are pretty mind-blowing.
They really are.
We are so used to seeing a massive chunk of our paychecks vanish before we even touch the money.
Yeah.
But originally in both England and America, there were absolutely no taxes.
Zero.
Zero.
It's almost impossible to conceptualize that today. A completely tax-free existence for the average citizen.
Right. So if there was no permanent income tax, how on earth did governments fund anything? Did they just not build infrastructure or fight wars?
They absolutely did, but they used temporary levies.
Temporary.
Strictly temporary measures used for existential crises.
Yeah.
Primarily wars.
Okay.
The king, or the president, would basically put the word out to the public, essentially passing the hat.
Hey, we need some cash.
Right, asking everyone to chip in to fund a specific finite conflict. And once the conflict was over, the tax vanished.
For example, in Britain, these temporary taxes were levied to fund the fight against Napoleon. That was roughly 1799 to 1816.
And in America, temporary taxes were introduced to pay for the Civil War from 1861 to 1865.
So for the vast majority of early history in these nations, the government didn't take a recurring cut of your labor.
No, they didn't.
But then permanent income taxes entered the chat.
1874 in England.
And 1913 in the United States with the adoption of the 16th Amendment.
And this brings up a massive psychological hurdle. Think about the cultural DNA of the United States.
Yeah.
You have a population that literally started the Revolutionary War, kicked off by the Boston Tea Party over a tax on tea.
The cultural resistance to taxation was fierce.
It was baked into the very foundation of the country.
So how do you sell a permanent income tax to a fiercely anti-tax population?
Right.
How do you convince people who went to war over tea to voluntarily hand over a percentage of their livelihood forever?
What's fascinating here is the explanation of the psychology behind that sales pitch.
It wasn't an overnight thing.
No, it was a 50-year campaign, and it was essentially a massive historical bait and switch.
Bait and switch.
The permanent taxes were initially levied only against the richest of the rich.
Okay.
The concept of the income tax was made popular and ultimately accepted by the voting majority by explicitly promising the poor and the middle class that this new tax was created solely to punish the wealthy elite.
So it's the Robin Hood myth weaponized as public policy.
Exactly.
They told the masses, don't worry about this new law, it won't touch you.
It's only going to take from those rich industrialists who have too much anyway.
And because the masses believed in that take from the rich fantasy, they enthusiastically voted for the law.
They voted to legally punish the rich.
But this is where the trap was sprung.
The tax was intended, or at least sold, as a way to punish the wealthy. But once the government infrastructure was built to collect that money,
And once the government got a taste of that revenue stream,
its appetite grew exponentially.
the bureaucracy expanded.
The funding needs expanded, and suddenly taxing just the ultra-rich wasn't enough to feed the machine.
It's like feeding a stray cat.
Yeah.
You give it a little bowl of milk once, and suddenly it's at your back door every single morning demanding more.
And eventually, it moves into your house.
That is a perfect analogy for how the expansion of government is framed here.
And think about how this connects to you, the listener. Consider how often public policy is sold to the public today on one specific, usually very appealing premise.
Like closing a loophole for billionaires.
Right. But over time, as circumstances change and budgets swell, the reality of that policy evolves.
He creeps downward.
It creeps downward, eventually impacting the exact middle-class people it was supposedly designed to protect.
The history of the income tax is presented as the ultimate example of this phenomenon.
It really makes you look at the phrase unintended consequences in a whole new light.
It does. But to really understand why this happened, why the government's appetite for money grew so much, and why the rich didn't just passively accept being punished.
We need to look at the author's background.
Right. He grew up caught between two father figures with completely contradictory worldviews. Let's look at the educated dad first.
So the educated dad is described as a highly prominent government leader, a dedicated bureaucrat.
Okay.
And he was a man who sincerely, deeply believed that government should help people. He was incredibly mission-driven.
He was a huge fan of John F. Kennedy.
And he especially loved the ideals of the Peace Corps. In fact, he and his wife actually worked for the Peace Corps,
Dedicating their time to training volunteers to go to places like Malaysia, Thailand, and the Philippines.
So this is a guy whose heart is in public service and global aid. He wants to lift people up.
But the material asks us to look very closely at the incentive structure of his profession.
Yes.
In government bureaucracy, how do you measure success?
In the bureaucratic world, your success is largely measured by how much money you spend and how many people you hire.
The larger your organization is, the larger your budget is, the more respected you are within that ecosystem.
You are constantly striving for additional grants, larger appropriations, and budget increases.
Which means your professional survival depends on the expansion of the very government appetite we just talked about.
Exactly.
If you are running an agency and you manage to be incredibly frugal and only spend half your budget, you aren't rewarded with the bonus.
You are penalized.
The government looks at you and says, oh, you didn't need all that money. Great, we are cutting your budget for next year.
It's a use it or lose it system.
So the incentive is to spend every single dime and ask for more.
And naturally, this educated dad viewed the wealthy as greedy crooks who should absolutely be made to pay more taxes to fund these vital programs.
Now contrast that entirely with the rich dad, the capitalist.
His worldview and his incentive structures are the exact opposite.
Right.
For the capitalist, success isn't measured by how big his organization is or how much money he spent. It is measured by extreme ruthless efficiency.
For the rich dad, the fewer people he hired and the less money he spent to achieve a goal, the more he was respected by his investors.
It's a complete inversion of the government model.
In the business world, excess money profit is rewarded. You are applauded for doing more with less.
Precisely.
Mm.
Because of this fundamental difference in how money is handled, the rich dad had a very harsh view of the government ecosystem,
He viewed government workers as incredibly inefficient,
famously referring to them as a pack of lazy thieves.
a pack of lazy thieves, because they were constantly taking capital out of the productive economy to fuel a system that rewarded bloated spending.
So you have a government dad who thinks rich people are greedy crooks, and a rich dad who thinks government workers are lazy thieves.
That is quite the dinner table dynamic to grow up with.
It really is.
But as the author synthesized this conflict, a very clear perspective emerged regarding that take from the rich Robin Hood theory.
The conclusion drawn is that the socialists, the take from the rich crowd, ultimately penalize themselves due to a severe lack of financial education.
They fundamentally misunderstood how the capitalist mind works.
The assumption behind the early income tax was that the wealthy would just sit there, recognize the new law, and voluntarily hand over their fortunes.
But the rich don't just comply.
They react.
Exactly. They have the money, the power, and the intent to change the rules of the game.
When the masses voted to tax the rich didn't just surrender.
They used their resources to hire the smartest attorneys, to hire brilliant accountants.
To persuade politicians to change laws and to uncover massive legal loopholes.
They outsmarted the intellectuals who wrote the tax code.
Because they understood the power of money and the mechanics of the law, subjects that are deliberately not taught in schools.
So while the government's appetite for money grew and the tax net was cast wider and wider until it swallowed the middle class, the true capitalists used their financial knowledge to build an escape route.
And that escape route leads us directly to the creation of the ultimate legal shield,
The corporation.
the corporation.
Here's where it gets really interesting.
Yeah.
When we hear the word corporation today, we instantly visualize a massive tech campus in Silicon Valley, right?
Or a huge automotive assembly line, or a multinational retail chain with thousands of employees.
But the true origin of the corporation traces back to a completely different era.
The days of sailing ships.
This historical context is vital to understanding how wealth is protected.
During the era of sailing ships, the wealthy elite in Europe were looking to finance voyages to the New World in search of exotic goods, spices, and treasure.
But these voyages were incredibly perilous.
Ships sank in storms, they were attacked by pirates, they were lost to disease.
If a wealthy individual financed a ship using their own personal name, and that ship sank to the bottom of the ocean, they were personally liable for the entire loss.
The creditors could come after their personal estate, their castles, their land.
They could be completely, utterly ruined by one single bad voyage.
So they needed a way to mitigate that massive existential risk.
They needed a firewall between their personal wealth and the risky venture.
And that firewall was the invention of the corporation. They created the corporation as a vehicle to limit their risk strictly to the assets of that single voyage.
The mechanics of it are brilliant. The rich investors would pool their money and put it into the corporation.
The corporation, as a separate legal entity, would buy the ship and finance the voyage.
The corporation would hire the crew to sail to the New World.
If the ship was lost at sea, the crew unfortunately lost their lives. But for the wealthy investors, the financial loss was strictly limited only to the money they had put into that specific corporate venture.
Their personal estates, their homes, their generational wealth, it was all completely protected and untouchable.
They isolated the risk. The crew risked everything, but the investors limited their financial exposure.
And that core concept, limiting personal liability and creating a separate legal entity, is the exact foundation of what a corporation is today.
Which brings us to a crucial clarification. What actually is a corporation today?
Right. If I want to start one, do I need to buy a glass building? Do I need to hire 100 people?
Not at all. And this is where many people who have never formed one fundamentally misunderstand the concept.
A corporation is not a building.
It is not a factory. It's not a group of people.
It is simply a legal document that creates a legal body without a soul.
A body without a soul.
It sounds almost poetic, but practically, what does that mean?
Practically, it means it is just a file folder. It is a few pieces of paper sitting in an attorney's office or registered online with a state government agency like the Secretary of State.
You pay a small filing fee, submit some paperwork, and suddenly the law recognizes the birth of a new person.
A corporate entity, they can open bank accounts, sign contracts, and hold assets completely separate from you as a living, breathing human being.
It is a legal fiction, but a legal fiction with immense real-world power.
Because by using this soulless legal body, the wealth of the rich was once again protected.
Not just from sinking ships, but from the ever-expanding reach of the modern taxman.
And this is where we have to dive into the heavy math. We need to look at what is described as the ultimate tax loophole.
Which comes down to a fundamental disparity in how the cash flow velocity of an individual is treated versus a corporation.
Let's walk through this cash flow velocity carefully because it is the linchpin of the entire strategy.
Let's do it.
Let's start with the financial cycle of a normal W-2 employee. The cycle operates in 3 very rigid steps.
Step 1, the employee earns. They perform their labor and generate a gross paycheck.
Step 2, the employee pays taxes. But notice the order here. The government takes its cut right off the top before the employee ever even sees the money in their bank account.
Step 3, the employee spends. They try to live their life, pay their mortgage, and buy their groceries, using only whatever crumbs are left over after the government took its massive bite.
Earn, tax, spend.
Now compare that to the financial cycle of a corporation. It also operates in 3 steps, but the order is completely rearranged.
Step 1, the corporation earns. It generates revenue.
Step 2, the corporation spends. It pays every single legal expense it can possibly justify using pre-tax dollars.
And step 3, it pays taxes only on the net profit that is left over after all those expenses are paid.
Earn, spend, tax.
It is a massive paradigm shift. Paying expenses before paying taxes is perhaps the biggest legal advantage built into the system.
Because a corporation is a separate legal entity, it can absorb costs that an individual cannot.
Let's ground this in reality. Give me an example of how a corporation spends pre-tax dollars on things a normal person has to buy with post-tax dollars.
Okay, well, if you are an employee and you want to go on vacation to Hawaii, you have to save up the money that is left over in your paycheck after taxes and buy the plane tickets.
Right. But if you own your own corporation and your corporation does business in Hawaii, or you hold an annual board of directors meeting there,
The plane tickets, the hotel, and the meals can legally be classified as corporate expenses.
the corporation pays for it before taxes are calculated.
The same goes for vehicles, right? If I want a truck to get to work, I buy it with my leftover taxed income.
Exactly. But a corporation can purchase a vehicle for business use, deduct the depreciation, deduct the insurance, deduct the maintenance, and deduct the gas.
Health club memberships, continuing education, large portions of restaurant meals.
If they are tied to the generation of business revenue, the corporation buys them with pre-tax dollars.
The corporation earns the money, buys the boss a trip to Hawaii for a board meeting, leases a company car, and then only pays taxes on whatever fraction of the revenue is left over.
Meanwhile, the employee is funding their entire life with money that has already been aggressively taxed.
And to connect this directly to you, the listener, think about the timeline of your own labor over a calendar year.
If you look at the average tax burden, federal income tax, state tax, payroll taxes, property taxes, sales taxes.
The average American works 4 to 5 months out of the year just to cover their obligations to the government.
From January to sometime in May, every single hour you work, every dollar you generate is essentially going straight to the tax man.
You don't start working for yourself until late spring.
Almost half the year.
And the argument here is that the middle class pays this exorbitant price simply because they are intimidated by the system.
The rich dad didn't fight back against the government by protesting or refusing to pay.
He just played the game smarter.
He used the legal fiction of the corporation to shield his cash flow.
The overarching suggestion is that the take from the rich Robin Hood strategy backfired so spectacularly that the middle class is now trapped in a grueling cycle of heavy taxation.
While the true capitalists sit comfortably behind the legal walls of their corporate file folders.
Okay, the theory makes total sense. Earn-spend tax is mathematically vastly superior to earn-tax-spend. But how does an actual average person pull this off? Is this just armchair philosophy? Or did the author actually execute this in the real world?
He absolutely executed it, and his journey in his mid-20s is a fantastic illustration of these concepts in action.
So after finishing his service in the Marine Corps, the author entered the corporate world.
He got a job working as a salesperson for Xerox, and he was incredibly good at it.
He was highly successful, closing deals and generating massive commissions.
But he immediately ran into what we could call the paradox of success within the employee quadrant.
The paradox being that the more successful he was, the harder he was punished.
He was making a lot of money selling these Xerox machines,
Hmm.
but every time he opened his pay stub, he was shocked by how much the government was taking.
The harder he worked, the larger his tax deductions became.
His bosses at Xerox were flattering him, talking about moving him into management, giving him raises.
But he constantly had his rich dad's voice echoing in his head, asking, who are you actually working for? Who are you making rich?
This was the moment the conflicting advice of his two fathers truly collided in reality.
His highly educated dad looked at his success at Xerox and said, this is wonderful. Keep working hard, get those promotions, and work your way up the corporate ladder.
But when he brought that same success to his rich dad, the rich dad just chuckled at the idea of climbing the ladder and asked one devastating question.
Why not own the ladder?
The rich dad warned him that by relying solely on a W-2 paycheck from a massive corporate employer, he was positioning himself as, and this is a direct, brutal quote, a docile cow ready for milking.
A docile cow ready for milking. It is vivid, and it perfectly encapsulates the total lack of power an employee has over their own taxation.
The government attaches the milking machines before the cow even sees the milk.
So motivated by this realization, the author made a pivot.
He decided to stop being the cow.
In 1974, while he was still a full-time, dedicated employee at Xerox, he formed his first corporation.
He began to focus on what he calls minding his own business.
And it is important to note, he didn't dramatically quit his day job. He didn't storm out of Xerox.
In fact, having this new corporate vehicle on the side actually made him a better employee.
He came in early, he worked diligently, and he was highly motivated to amass as much money as possible from his sales commissions.
Why? Because he needed capital to fund his corporation.
And he saw a massive opportunity on the horizon. Hawaii real estate was just beginning to boom.
And he knew there were fortunes to be made if he had the capital to deploy.
So he funneled his Xerox commissions directly into his corporation to invest in that booming real estate market.
He was entirely motivated by his desire to escape the rat race, and his strategy worked flawlessly.
By 1978, he was consistently one of the top 5 salespeople at Xerox globally, but his real wealth wasn't his W-2 salary.
It was the cash flow building up inside his real estate corporation.
This brings us to my absolute favorite anecdote in this entire deep dive, the Porsche example.
In less than 3 years, the author was making more money passively inside his real estate holding corporation than he was making actively pounding on doors selling copiers for Xerox.
The cash flow from his apartment buildings became so strong that his company bought him his first Porsche.
Now imagine the optics of this. His fellow Xerox salespeople saw him pulling into the parking lot driving a brand new luxury sports car.
They immediately assumed he was doing what most highly taxed employees do when they get a big bonus.
Blowing his hard-earned sales commissions on a flashy liability.
They thought he was squandering his money to look rich.
But they were completely wrong. He wasn't spending his commissions on the car.
He had invested his commissions into cash-flowing assets.
And here's the genius part, the part that perfectly ties back to the corporate loopholes we just dissected.
His money was working hard to make more money acting as an employee.
Each dollar in his asset column was out there working 24/7 to generate more dollars.
And eventually, that pool of assets generated enough cash flow to buy the boss a new Porsche with before-tax dollars.
It is the ultimate flex of the rich dad's philosophy.
The asset bought the luxury, and it did so through the corporate structure, maximizing the pre-tax advantage.
He wasn't scraping together whatever was left in his personal bank account after the IRS took half his Xerox commission.
His corporation was leasing the vehicle as an expense.
By diligently applying these lessons, he was able to completely exit the rat race at a very early age.
He owned the ladder. He stopped being the docile cow.
And the author explicitly states that escaping this cycle was only made possible because he had cultivated a very specific, robust foundation of knowledge.
He calls this financial intelligence or financial IQ.
If we connect this to the bigger picture, the fundamental argument is that with money comes great power, but that power requires immense knowledge to maintain it and multiply it.
Without that specialized knowledge, the taxman creditors, inflation will simply push you around and drain your resources.
So the author breaks down this required financial IQ into 4 distinct vital pillars of expertise. Let's look at the first pillar.
Pillar number 1 is accounting.
The author defines this simply as financial literacy, or the ability to read numbers.
He calls this a vital skill if you want to build an empire, describing it as the left brain side of the equation.
It is the detail work. The more money you are responsible for, the more precision and accuracy are required.
If you don't have a rock-solid grasp on accounting, The warning is that the house comes tumbling down.
Financial literacy in this context is specifically the ability to read, analyze, and understand financial statements.
Income statements, balance sheets, cash flow statements.
This is what allows you to look under the hood of any business or investment and instantly identify its underlying strengths and weaknesses.
It is the foundational vocabulary of wealth.
Okay, so accounting is the left brain foundation. Pillar number 2 is investing.
This is defined as the science of making money.
It involves strategies, formulas, and creative deal structuring.
If accounting is the rigid left brain, detail work investing is the highly creative right brain side.
It is the actual engine of wealth creation.
Moving on to pillar number 3, understanding markets.
This is the science of supply and demand, but it goes much deeper than a high school economics class.
You need to understand both the technical aspects of the market, which are largely driven by human emotion, fear, and greed,
as well as the fundamental economic aspects of an investment.
Right, you have to be able to look at a property or a stock and ask, does this investment make sense based on current macroeconomic conditions?
You need to be able to read the room, essentially.
You need the math to work, but you also need to understand the mood of the market.
And finally, we arrive at pillar number 4, which is arguably the most powerful.
It is the wrapper that surrounds the other 3 pillars and causes explosive exponential growth.
The law.
The law is the protective shield.
A person who deeply understands the tax advantages and the legal protections provided by a corporation can accumulate wealth so much faster than someone who is just a W-2 employee or a small business sole proprietor.
The comparison used is someone walking versus someone flying.
The mathematical difference over a lifetime is staggering.
We already went deep on the tax advantages, the magic of paying expenses before taxes. But there is another massive advantage under the umbrella of the law.
And that is the concept of tax-deferred growth.
And there's a specific piece of real estate jargon mentioned here that is worth clarifying because it is essentially a legal cheat code for building wealth.
Section 131.
Yes, Section 131 is a specific provision in the United States Internal Revenue Code.
The author points out that the tax code is essentially a rule book, and it allows for massive tax reductions if you know how to play the game.
The 1031 exchange allows a real estate investor to legally delay paying capital gains taxes on a property they sell,
provided they take all the profits and roll them into a more expensive piece of real estate.
Let's really walk through the mechanics of this because it is mind-blowing when you realize how it accelerates wealth.
Imagine you buy a small duplex for $200,000.
5 years later, the market booms, and it's now worth $400,000.
If you just sell it outright and take the cash, the government is going to step in and demand a massive percentage of that $200,000 profit in capital gains taxes.
You lose a huge chunk of your equity immediately.
But if you utilize a Section 1031 exchange, you take that entire $400,000, including the $200,000 profit.
And you immediately use it as a down payment on a $1 million apartment building.
Because you didn't pocket the cash, but instead exchanged it for a larger asset, you pay absolutely zero taxes on that gain today.
Your entire pile of equity goes to work for you in the new, larger property.
And the craziest part is that you can theoretically do this forever.
You trade the $1 million building for a $5 million complex, then a $20 million commercial center.
You are continually rolling your profits forward, compounding your wealth tax-free until you die.
It is like trading up houses in Monopoly, but without ever having to pay the bank a fee when you make the swap.
People who don't understand these legal frameworks are missing massive opportunities to aggressively build their asset columns.
And beyond tax deferment, the law also provides the ultimate defense mechanism, protection from lawsuits.
We live in a highly litigious society. If you accumulate wealth, you become a target.
Everyone wants a piece of your action.
The wealthy use vehicles like corporations, limited partnerships, and trusts to legally separate themselves from their assets.
This is where we get into some truly elite-level strategy.
When someone tries to sue a wealthy individual, they hire lawyers to peel back the layers of the onion, looking for bank accounts and properties to seize.
But what they often find is that the wealthy individual actually owns nothing in their own name.
Everything is held by a web of corporate file folders.
And this leads to one of the most powerful paradigm-shifting quotes in the entire analysis.
They control everything but own nothing.
It is a profound legal distinction. The poor and the middle class try to own everything in their own names.
They want their name on the deed to the house, the title to the car, the bank accounts.
And because they legally own it, they can legally lose it to creditors' lawsuits, or the government.
The wealthy, however, use the law to control the assets through their corporate entities without actually owning them personally.
They dictate what the money does, but they are personally insulated from the liability.
It is the ultimate synergy. The accounting allows you to read the numbers.
The investing strategies find the undervalued real estate.
The understanding of the market tells you the timing is right to buy.
And the law, using Section 1031 exchanges and corporate liability shields, allows you to protect that money from taxes and lawsuits.
That combination is what constitutes true financial IQ.
So what does this all mean? We have covered a massive amount of ground today.
We explored the myth of Robin Hood, the evolution of zero taxes to a permanent income tax,
The battle of ideologies between the bureaucrat and the capitalist.
the invention of the corporation as a risk shield during the sailing days, and the 4 pillars of financial intelligence.
But if we distill all of this down to a single overriding lesson, it is this. The biggest bully in your financial life isn't your boss.
It isn't your supervisor.
The biggest bully is the tax man. And the tax man will always take more if you let him.
The central thesis is that knowledge is quite literally power.
If you simply work for money, relying solely on a W-2 paycheck, you voluntarily hand all your power over to your employer and to the government.
You let them dictate the terms of your financial existence.
But if you learn how to make money work for you and you understand the legal frameworks available, you keep the power.
You maintain control over your labor.
There's an ongoing war between the haves and the have-nots, and it has raged for centuries.
This battle isn't fought on a battlefield. It is waged wherever laws are made and tax codes are written.
And the tragic reality presented here is that the losers in this war are the uninformed.
The losers are the people who simply get up every day, diligently go to work, and pay their taxes out of a sense of fear and intimidation because they don't know any better.
The entire goal of unpacking this material today was to look at the financial aptitude required to understand the rules of the game as the wealthy play it.
If you understand how the game is actually structured, you have a fighting chance to change your position on the board.
Exactly. You don't have to be the docile cow. Now, before we wrap up, I want to leave you with a final provocative thought to mull over as you go about your day.
We spent a lot of time today talking about how the wealthy use the legal fiction of a corporation, that simple, soulless file folder in an attorney's office, to shield their assets.
The ultimate financial flex, as we discussed, is to actively try to control everything but legally own absolutely nothing.
But I want you to think about what we are taught our entire lives by society.
The traditional American dream is entirely centered around the concept of personal ownership.
Owning your house, owning your car, owning your possessions in your own name.
It is sold to us as the ultimate status symbol, the sign that you have made it.
So here's my question for you.
If the most legally and financially secure people in the world, the true capitalists who write the rules, are actively utilizing the law to ensure they legally own absolutely nothing,
How does that change the way you view the things currently sitting in your driveway or in your living room?
are the things you proudly own actually serving you, or are they just making you a bigger target?
It's something to think about.
Thank you so much for joining us on this deep dive. Keep questioning the narratives, keep building your knowledge, and we will see you next time.